So I guess what I'm saying is, yes, I think the Fed's going to continue to cut rates over the next 12 months. Little doubt in my mind about that, but maybe the market's being a little optimistic. So in the short term, I think we could get a bit of a pullback from gold and silver. But that's only short term, frankly. And, the resilience that gold has exhibited over the last 6 months, and but particularly just over the last several weeks, the resilience is really quite astonishing. China was the number one buyer. We've had 4 months now without them buying at all. And, the market's hardly stopped moving up.
Wow.
Which is a very, very strong sign of disbursement in buying and a very deep market. I don't expect a deep correction. It may not even be a correction. It may just be a kind of pause for a week or 10.
AdrianDay is a prominent investment manager and financial expert known for his expertise in global markets, particularly in precious metals and mining stocks. He predicts a decline in the US dollar over the next 2 years due to growing twin deficits and a slowing economy. He emphasizes that while the dollar has historically remained strong as the world's reserve currency, its status is gradually diminishing, reinforcing the expectation of a weaker dollar moving forward. This reckless increase in debt is happening in an economic growth period. However, if we adjust for government debt accumulation, 2021 to 2024 were the worst years of growth adjusted for debt since the 1930s. Furthermore, the inflationary limit is evident due to a 20% increase in inflation over the past 4 years, a 30% increase in the cost of basic groceries, and persistent inflation, which is exemplified by the constant decline in the purchasing power of the US dollar. Despite China's recent inactivity in buying and market weaknesses, Adrian maintains a bullish outlook on gold and silver. He noted that the exponential rise in gold prices calls for consolidation, and highlighted Monetary Metals' introduction of a unique silver bond offering 12% interest, a rare opportunity. Central banks, especially in emerging markets, have heavily increased gold purchases to reduce their dependence on the US dollar. For example, China's central bank went on an 18-month gold buying spree, ending in May. June and July saw India's central bank boosting its gold reserves. However, Adrian also suggests that the extensive currency creation in the stock market and real estate may lead to a decline in inflated values. Now, we present the clips of AdrianDay's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I think on balance, certainly over a 2-year period, we're going to see a lower dollar. And that's for a lot of reasons. The US, if you looked at the US in isolation, which of course, doesn't make sense, but if you looked at the US in isolation, with twin deficits, large budget deficit and a large trade deficit. Twin deficits have traditionally been weak for economies, a slowing economy, lower interest rates. All of those things would point towards a lower dollar. Now, what of course has kept the dollar high over the last 5, 10, 20 years, despite the twin deficits that are large and have been growing, is the fact that the dollar is the world's reserve currency. But as we know, it is slowly, but inevitably, it is losing that position. And so when you combine the economic position together with a continuation of a reduction in the status of the world's reserve currency, I think you're looking at a lower dollar, certainly on a 2-year basis. Certainly from a longer term point of view, I couldn't be more bullish on both gold and silver than I am right now. And we can talk about that part of it if you want, because I think it's important to put it in a context. Certainly the last few days have been kind of weak for gold since last Friday, really. For gold, for silver, and for the mining stocks. I said I was looking for a pullback, but not for the reasons that it came. Look, anytime you see a thing run up the way it's just run up, and you look at a graph of maybe the last 3 years, well, the last 6 months have been, or the last 2 months has been kind of exponential, or almost. And, you just can't expect that to continue without, at the very minimum, a pause, if not a pullback. That's number one. Number two, of course, is the Fed rate cut, but spiked the latest rally. So that's behind us. And so now the market's looking ahead to what's next. And the jobs numbers on Friday, the jobs report, US jobs report on Friday would suggest that the Fed may be a little slower at cutting rates, certainly than the market is anticipating. I think the market, frankly, I'm not saying the market's expectations are impossible, but I think they're certainly optimistic. I think another 2 rate cuts this year and then 3% a year from now. I'm not saying that's impossible, but that's certainly optimistic, which means that you've got the possibility or the risk of things not going the way you expect. So a jobs report, if the inflation numbers this week come in low, that's one more factor that will weigh on gold and silver in the near term. I think the Fed's going to continue to cut rates over the next 12 months. Little doubt in my mind about that. But maybe the market's being a little optimistic. So in the short term, I think we could get a bit of a pullback from gold and silver. But that's only short term, frankly. And, the resilience that gold has exhibited over the last 6 months, and but particularly just over the last several weeks, the resilience is really quite astonishing. So, when China stopped buying gold, you hardly got a blip in the market. China National Bank, the People's Bank, stopped buying gold. You hardly got a blip. We've been 4 months now without China buying. China was the #1 buyer. We've had 4 months now without them buying at all. And, the market's hardly stopped moving up.
Wow.
Which is a very, very strong sign of a disbursement in buying and a very deep market. So I don't expect a deep correction. It may not even be a correction. It may just be a kind of pause for a week or 10.
On the basis of fundamentals, AdrianDay highlights that gold and silver are essential for safeguarding purchasing power. While both metals have seen substantial price increases, gold stocks have yet to exhibit their expected leverage in this bull market. Adrian predicts that the Federal Reserve's rate cuts and a changing economic outlook will enhance leverage for gold stocks. Gold equities as a group are trading at the same level as they were in 2020. Back then, the gold price was $600 lower and well below the historical highs reached in 2011. Why haven't we seen a stronger response from gold stocks this year? For example, gold was up over 5% in September, while the NYSE Arca Gold Miners Index, GDMNTR, was up only 3.07% during the month. The MVIS Global Juniors Gold Miners Index, MVGDXJTR, was up 6.62%, which outperformed gold, but not as much as expected. Gold and gold stocks are among the best performing assets in 2024. Gold stocks are up 28% year to date, which is in line with the metal but below our expectations, given their strong leverage to the gold price. Technically, he remains optimistic for the upcoming months, arguing that many gold stocks are undervalued when assessed against historical price-to-cash flow and price-to-net asset value ratios.
I mean, a new investor, if you're concerned about the purchasing power of your money, which you should be, I mean, the number one thing you want to put your money into is you want to put your money in places that's going to protect that purchasing power. And the number one place that's going to protect purchasing power, obviously, is gold and silver, the two monetary assets. I think beyond the physical, beyond having a core holding in the physical, which I regard as savings, I don't regard it as an investment. I regard it as like having insurance. And the gold stocks are still, and I think it's important to emphasize this point, despite the fact that the gold stocks have gone up by over 50% since gold bottomed 2 years ago. If you go back to October of 2022, I guess you could call that a bottom. There have been several bottoms along the way, but that was the last, that's a bottom that we haven't gone below since then. So if that's the bottom of the gold market, gold has gone up 57%. Gold stocks have gone up about 53% since then. So that's nothing to sneeze at, right?
Yeah, that's lots.
But the point that's really important, and I really want to emphasize, or several points, but the main point I want to emphasize is, gold stocks have gone up 53% in those 2 years, while gold has gone up 57%. You can look at 1 year, you can look at year to date, you can look at the last 6 months, and whichever time frame you want to look at, although the gold stocks have done well, they haven't exhibited the leverage, nor has silver yet, the leverage over gold bullion. And that's important. I don't know if, well, I've got a chart up here. I guess I can't share graphs, can I? But I've looked back at last bull markets for gold, last markets for when gold took off. And if you look at the absolute bottom of gold, that's the starting point. Whenever gold bottomed, and I've looked at like 1986, in the first 12 months, gold was up 6.3%. The XAU was up 82%.
Yeah.
In 2001, gold was up 12% in the first 3 months. Gold stocks were up 43%. So you can see, and we could go through every single period if you want. And so normally at the beginning of a bull market, gold stocks exhibit tremendous leverage. We haven't exhibited that leverage yet. And there are logical reasons for that. We shouldn't get upset. A lot of people say, why are the gold stocks lagging? But there's logical reasons for that. If you look at who was buying gold for the last 2 years, and particularly the last 12 months, and why they were buying, it was nothing at all to do with the macroeconomic environment. But that's beginning to change with the Fed cutting rates, with the economy clearly slowing, and the Fed cutting rates before inflation is really under control, the dollar dropping. All of these things are changing the macroeconomic environment to where it's favorable for the monetary metals. So I think we're going to see that leverage over the next 6-12 months. We're going to see that leverage exhibit itself. And even though the gold stocks are up, as I say, over 50% since in the last 2 years, you can look at companies like Agnico that is selling within the lowest 10 percentile of this. You look at Barrick that is trading within 10% of its lowest price to net asset value. When I say it's lowest, I'm talking about over 40 years.
Yeah.
Now, when gold is at all-time highs, and when the outlook to me looks reasonably strong, these stocks should be having multiple expansion. They shouldn't be trading at close to their lowest ever multiples.
While the price of gold is expected to continue rising for the rest of 2024 and into 2025, investors who want to add the precious metal to their portfolios still have opportunities. Given the current economic landscape and the performance of precious metals, what strategies do you believe investors should adopt to navigate potential market fluctuations? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.